The yield curve has inverted plenty of times in the past, and every time it happens, it's kind of like a flashing warning sign for an impending recession. But this one is breaking records.
Let's talk about treasuries. One of our colleagues on the Markets Live blog out with an interesting piece, Garfield Reynolds, saying that treasuries look closer to the start of a new bull market. And of course, this comes after we've heard from certain bond market legends talking about how we're still at the end of the last bull market. So how can it be both? What's his thinking?
I think Garfield's piece is really good here. I'm not sure if I entirely agree with him. I think the point is making that you now get enough yield return that it becomes a viable long-term structural asset class, as in what you're basically earning in yield rewards them to hold them for the longer term. And that makes it possible for a greater suite of investors to get involved. Where I am with Garfield is that this is more appealing at the front end of the curve, and therefore I think the dynamic here is much more likely to lead to curve steepening. I am basically in the camp that actually I am still bearish bonds overall, but I think I'm bearish more the long end, so therefore you get steepening. But in Garfield's scenario where he's bullish bonds, he actually sees it as being a bull steepening, and therefore either way the clear conclusion is the yield curve can steepen further in the US.
So the real question is, what will the real impact be? Like for the economy, the stock market, and for the average Joe. So if the yield curve un-inverts with the long bond yields going higher instead of the short-term bonds going lower, are we about to see a sovereign debt crisis in the Western world, like Greece saw in the mid-2000s? Will banks and credit freeze? Now, if the Fed intervenes and starts buying long-term bonds, will we see a massive inflation spike up again? Are we in for something completely unexpected? Buckle up, guys, because this financial roller coaster just got a whole lot more intriguing. Now, as usual, it all goes back to the Fed. To fight high inflation, the Fed has been consistently raising interest rates. As of July 2023, interest rates have been increased 11 times ever since March of 2022, going from 0.25% to 5.50%. Now, for investors in the fixed income investments, rising interest rates have translated to higher rates on U.S. treasuries and deposit accounts like checking and savings accounts. But these increases could also mean trouble ahead. Now, you always hear about the news talking about the yield curve, right? Basically, it's a graph that shows the interest rates of U.S. treasuries over a different range of maturities. Now, in normal times, the yield curve slopes upward to the right. Why? Well, because investors earn higher yields the longer that it takes for a bond to mature. Now, short-term bonds, they provide less income to investors because holding an investment for a shorter period of time involves less risk. Now, a downward trending or inverted yield curve means that you can earn less on securities than you plan to hold for longer. And this is a sign that something in the economy is amiss. I mean, like, what incentive would someone have to buy a longer term bond that they can earn more while having their money locked up for a shorter period of time? Chances are they wouldn't, which is exactly part of the problem with the current US yield curve. Now, thanks to the Federal Reserve raising interest rate, short-term rates between 4 to 52 weeks, they are aggressively higher than longer-term bonds over 5 years. I mean, it's definitely a hard sell to convince somebody that a 10-year bond at 4.2% interest is a better investment than a 4-week bond of just over 5.5%. And this inverted yield curve usually predicts a recession in the offing for a lot of reasons. The banks can earn more money by holding on to short-term treasury bonds than by lending for a longer time frame. They may decide to slow down long-term lending, like mortgages, to maximize short-term profits. It just makes more sense to use funds to earn over 5% interest within the year than to lend out money and earn just over that for a 30-year mortgage. Now, what's especially scary about this one is that the current inversion of the US yield curve hasn't been this steep in close to 4 decades. And like I said, it's usually a sign of an approaching recession. But right now, the New York Fed is indicating a 66% chance of the US recession by July of 2024. For investors, this should mean a hope for the best, prepare for the worst type of situation. But let's be honest here. You can't exactly control recessions or economic downturns, but you can control how you approach them. And so that means looking into what works and what doesn't during uncertain times. Certain sectors like utilities, consumer staples, and healthcare, they tend to thrive during recessions because they provide products and services that people need regardless of economic conditions. I mean, a lot of expenses will be cut from people's budgets before they look at their power, their cell phones, or medicine. And by then, things would have gotten a whole lot worse that your portfolio may be the last thing on your mind. On the opposite end, you got sectors like consumer discretionary, financials, and real estate that tend to have down periods during recessions. And as always, diversify, diversify, diversify. You don't want to let the economy just completely dictate your investment plan because it could be towing the line of attempting to time the market and throw off your portfolio allocation. But hey, there's nothing wrong with adjusting for the economy, right? Consider this. Folks who are nearing retirement, they might be thinking now's the perfect time, the perfect moment to shift more of your investment portfolio toward reliable blue chip stocks. That way you could shield yourself from the roller coaster like swing in the market, especially when you're about to really need that money. Now, on the flip side, younger investors might see this as a prime opportunity. They might be loading up on financial stocks that are currently going for a steal because they believe in the long game. They've got time on their side. After all, they can afford to wait for those stocks to bounce back. So what's the name of the game here? Well, it's all about sticking to your plan while also keeping an eye out for opportunities that pop up along the way. Remember, the economy has this cyclical thing going on, and recessions, they're just a natural part of that cycle. They're not exactly a walk in the park, but they do highlight why it's crucial to keep your sights set on the long haul. Make adjustments as needed, but don't necessarily throw your entire strategy out the window. Some say this recession is going to be severe and it's going to last a long time. I say, let's be ready just in case. You know what I'm saying? And part of getting ready is subscribing to the channel and turning on that notification bell. You don't want to miss the update when one comes crashing down on our heads, right? At least we'll be ready for sure. One big happy financial family, right? Thanks for always being there, you guys. Thank you for always watching and lighting up the like button. Totally appreciate that. I really appreciate you guys here on the channel. But anyway, so everyday investors, they don't usually pay too much attention to the yield curve. So when the yield curve does make headlines, you know it's a big thing that's setting off alarm bells among market watchers. Now this time, the disparity between two bonds in particular was the largest investors had seen since 1981. Essentially, the curve has been inverted. And now it's even more so. So what's the big deal, right? An inverted yield curve is a classic signal that a recession is on the horizon. Now they've tracked it. Ever since 1978, the yield curve has inverted 6 times, not counting the current inversion period. And each one of those times has preceded a recession every single time. When you're reading about the yield curve, it's almost always referring to rates paid by short and long-term U.S. Treasuries. Different market analysts like to use bonds of different maturities as proxies for a short-term and long-term bond. But by far the most popular are the 2-year and the 10-year Treasuries. So 2-year government bonds have been paying more than 10-year bonds ever since July. The 2-year Treasury yielded 4.94% versus a 3.86% yield on a 10-year bond. That is a huge gap. And this gap was the greatest in 42 years. And so basically, you have a large chunk of investors who have grown a little bit skittish about the economy, worrying that the Federal Reserve's aggressive rate hike regime could very well slow down the economy to the point that it tips into a recession. Now, in those scenarios, government bonds have been a safe haven. The U.S. government doesn't go out of business. Shaky companies do. Even pretty stable companies experience challenging times during recessions. But by flocking to long-term government bonds, investors drive up the price of those investments. And because bond prices and interest rates move in opposite directions, long-term treasuries have seen a decline in yield. Now, let me explain how this could all lead to a recession. Primarily, it's because it slows bank lending activities. And as they say, banks make money by borrowing short and lending long. So that means basically, typically the banks will take money that you and I deposit at a low interest rate and they lend it out to people who want longer term loans. People who are buying cars, maybe people buying houses, maybe people trying to get a business started or even expanding their operations, all at a much higher rate. Now, an inverted yield curve, it actually makes the math unprofitable for banks in a lot of cases. And so that means that they're more reluctant to lend to businesses which have a harder time expanding, which slows the economy and causes people to lose their jobs. You guys remember 2008, right? Yeah, that kind of thing. Plus, in another sense, an inverted yield curve coming before a recession, it's sort of a self-fulfilling prophecy. By moving money out to short-term bonds and into longer-term ones, investors are basically saying that an economic slowdown is coming sooner rather than later. Now, how long till we actually see this happen, right? Well, going back to 1978, it takes about 15 months on average for the economy to enter a recession after the yield curve inverts. And since this current inversion happened roughly a year ago, this means that the economy could very well enter a recession in October of this year. But honestly, this is a big range that we're talking about, and even past performance can be a little bit misleading. The last time that the yield curve inverted was 2019. A short recession did follow, but there were some other major forces acting on the economy at the time. And while some recession indicators are flashing red lights for investors, others are green as can be. Now, after all, the stock market is up a very robust 16% on the year. So not really a reflection of a pessimistic market. I guess the general advice here would be not to get too excited turning your oh no's into FOMOs. Don't get caught up in either one. Maintain your dollar cost averaging investment approach and realize more times than not that the market does go up. The August jobs report was another strong one, but signs of cooling are emerging. The economy added 187,000 jobs in August, slightly above what the market had predicted. The unemployment rate rose by 0.3 percentage points in August to 3.8%, up from the 3.5% which was recorded last month. Now, the jump means an additional 514,000 lost their jobs in August, bringing the number of unemployed people in the country to roughly 6.4 million. And while unemployment also increased, it's still not too far from a 50-year low. Now, a cooling jobs market could be the ingredient needed to get the Federal Reserve to hit the pause button on additional interest rate hikes and increases this month. Fed Chair Jerome Powell, he said last week at the Kansas City Fed's conference in Jackson Hole, Wyoming, that while inflation was moderated, it remained too high for their comfort and central bankers were preparing to tighten more if necessary. But hey, listen, we hear the government talking about inflation and, that's just the portion of inflation that the officials will admit to. A bigger concern for some people right now is our government leaders getting us into trouble, maybe even getting us nuked. Definitely stay safe, guys. If you made it this far on the video, drop a quick like for the video. Also subscribe to the channel. And if you'd like to start your own business, drop me a comment down below. I'd love to help you out. You guys take care and be safe.